The next instrument is reverse repo. So we know that repo is the interest rate that the RBI charges when it gives loans to banks. Now, who is paying the money? The interest is being paid by the banks to the RBI because RBI is giving money to the banks. Whereas, in the case of reverse repo, it is the other way around. RBI gives interest to the bank. Now, let's see how. So, banks have surplus money. Okay, the banks have surplus money and they don't know what to do with the surplus money. Surplus money means banks have a lot of excess cash with them which they don't want to give out as loans and they have it with them. Now what do they do with it? What would you do if you had a lot of excess money? Let's say you have 10 lakh rupees lying in your cupboard and you don't know what to do with it. What you would do is go put it in a bank because it's much safer there, right? And it's easier to store there. So just like that, now if we put it in the bank, where do the banks put it? Yes, the banks put it into the RBI. And when banks park their surplus capital with the RBI gives them an interest rate and that rate is called as reverse repo rate. This is the interest given by RBI to the bank. Okay. Now let's see how does increasing or decreasing reverse repo affect the money supply in the economy. So when reverse repo increases, what happens? So when reverse repo increases, that means the banks do not have to lend out the money as loan and get the interest from the people and get profit, but rather they can just park the money with the RBI and have no liabilities, easily make a lot of cash. Now, doesn't that sound good to the bank sometimes? If you are extremely hardworking and you want some, period of chill in between all that. So you don't want to do anything, but rather you do want to earn the profits. So what do? The banks put the money at RBI and RBI will give them interest. Now, isn't that great? Think about doing a lot of hard work to lend it to people, find people, get documents from them, then ask them to repay it. You don't have to do any of that. You just have to park your surplus money with RBI and RBI gives you quite a good amount of interest. So then what does the banks do? The banks park a lot of surplus with the RBI. That means they give a lot of money to the RBI. But what happens when a lot of money is given to the RBI? Do the banks have enough money to lend out to the people? No. When a lot of money goes to the RBI, they have less money to give the people because most of the money is sitting in RBI. And because of that, the money supply in the economy decreases because the credit creation in the economy decreases because the money that the banks have, it's parked with the RBI and they're not using the money to give out loans. How are people going to get loans if they are not giving loans? So that is the relation between reverse repo and money supply and credit creation. And on the other hand, if reverse repo is decreased, that means the Reserve Bank is not giving them enough interest for parking their surplus with the Reserve Bank. Now this disincentivizes the bank to park the surplus with Reserve Bank of India. They would rather give out loans and get much more profit than just put their money with the RBI and get a very low amount of interest from the RBI. And hence when reverse repo decreases, we have increased credit creation and increased money supply in the economy. So that is about reverse repo rate. And one thing you can note here is that repo rate, that is this, and reverse repo rate, that is this, together are known as liquidity adjustment facility. It's just a term we use because using this, the Reserve Bank can adjust the liquidity in the market, that means control the money supply. So this is a term that you can remember, that is liquidity adjustment facility. Thank you.